And I went to kindergarten, to this kindergarten called Bialik School. There was Bialik School.
All right, let's take a look at Atlassian, which is a fantastic company, one of the companies I look up to. Team Anywhere, San Francisco, Anywhere team. Cool headquarters there, but also San Fran, just in case y'all forgot. Shares outstanding, 250 million, 253 million shares outstanding. Imagine owning them all. $48 billion company. I think it's going to go up even more, but that's a whole other story. We'll get to that later. Let me add this model stuff. Well, I have to close out everything if I do. Let's see. So yeah, 253 million shares outstanding as of last quarter. What did I do there? All right. Let's see, kind of probably put this somewhere else, but they got about $1 billion of cash. Not too much, actually. Strategic investments 150. That's 1.4 billion total of cash. Like not much for a $48 billion company. I would inflate both sides of the balance sheet if I were them. And they have $1 billion of debt. It's kind of interesting. They must have done some acquisitions. So basically no net cash for Atlassian, which is not typical in so-called big tech. I wouldn't call them necessarily big tech, but they're getting big tech. Still sort of a small, scrappy company in my eyes, but at $48 billion, one of the world's biggest software companies. All right, anyway, let's go to the income statement. Everybody knows what Atlassian does, more or less. Kind of the Jira company in a lot of ways. What did I say models for? What am I doing? My brain is running out of glucose or something. Chipotle? Chipotle? All right. Yeah, amazing revenue growth. Well, amazing subscription growth. It's great revenue growth. Amazing is too strong of a superlative. 740. So almost $1 billion last quarter, which makes it not one of the biggest software companies by revenue, but definitely one of the biggest software companies by market cap. We'll get through the valuation later. Subscription, maintenance, and other. So yeah, revenue growth is looks like around 33% or so. 30. Cost of goods, very low, as you would expect. I was joking with the about Snapchat. I was like, some of y'all software companies have margins like hardware companies. Y'all faking. You're faking like a Chinese Jamaican. 84%. Gross margins, that's more accurate. Look at that R&D spend. They're really investing a lot in product development. I think that's Wow, that's amazing. So if you take out R&D spend, the margins of the company are ginormous. And there's probably a lot of stock-based compensation in here too. So yeah, if I took out R&D, I would have 273 over. I mean it's good. But for a growing company, you're investing a lot in those types of things. So maybe, I don't know. We'll sort of keep looking. This is Atlassian, not Adobe. Alright, yeah, so outside of R&D, they would have a 47% operating margin. Obviously, you have to do product development, but some of that product development is opportunistic and related to future products, not just maintenance development on products they have now. Although, again, I don't know. We have to listen to company conference calls and ask around and stuff like that. Hedge fund people work at a hedge fund. Most day traders don't work at hedge funds. Most day traders, I would say, trade from home or something like that. There's certainly people at hedge funds who trade in and out every day. That's really the technical definition of a day trader, even though it's not a technical term. It's just a colloquial term. Somebody who's getting in and out of the markets very quickly. At one point or another, it was sort of disparaging, but I don't think so very anymore. Some investors do well in short time frames, some investors do well in long time frames. All right, so stock-based comp, as I mentioned, is enormous here. So if you take out stock-based comp on R&D or in the other pieces, yeah, you would have even higher margins. But stock-based comp is a real cost. I'm going to make some adjustments, not for stock-based comp, but for this amortization business. Okay. Wow, look at that. Cash flow and, well, I guess it's all coming from SBC, but you can see the gulf, the huge difference between cash flow and net income. Net income looks, this last quarter was negative, but real cash flow is $353 million. Amazing. This is kind of why people hate accounting. It's rather difficult to understand, and a big reason is, according to the accounting rules, stock-based compensation is an expense that has to be expensed on the income statement, but it doesn't cost money to issue stock, right? So if you expense it, you're artificially depressing net income down here by inflating these cost numbers, right? And if you need to open any one of my models on GitHub, you can kind of see what I'm talking about and work the numbers through yourself. But the actual cash coming in the door is pretty huge, whereas the net income is not. So if you take a look at that, and then let's see if they have CapEx. Very little CapEx, so it looks like most of their stuff is probably going up on AWS or something. Doesn't look like they're operating their own data centers and stuff like that, which is probably pretty smart. Let's see how they break down their business. Cloud, center. I didn't even know they made data center apps. That's cool. And server, which again, I'm not sure what that is exactly. I probably need a good refresher on their business. Yeah, I mean, stock-based comp is one of the most controversial topics in accounting. I was supposed to meet Paul Volcker before he died, and then he canceled the meeting because I'm a bad guy. Oh well. Rest in peace. All right. Revenue 710 to 725. It's the fiscal fourth quarter. I gotta adjust this calendar stuff. So this was 3/31/22. This was 3/31/21. Delete all this. This was fiscal Q3/22. Fiscal Q2/22. Fiscal Q1/22. Fiscal Q4/21. Fiscal Q3/21. Fiscal Q2/21. Fiscal Q1/21. Fiscal Q4/20. Fiscal Q3/20. Cool. Fiscal Q4/22. Gotta love that fiscal quarter BS. Scott Farquhar, what a hero. Mike Cannon Brooks, the other hero. Two guys started the company from scratch and have built it into one of the biggest, most successful companies in the world. Really amazing company. All right, so Jira, Confluence, Trello, Bitbucket. Pretty huge, legendary pieces of software there. Let's see, Confluence. Wonder what that is. Oh, it's Unity. Guided to 690 to 705, and they did 740. Holy moly. What am I looking for here? I want to edit this comment. let's see the rest of this income statement. 508,987, 127,059, 80. All right, revenue growth was 37%, now it's 30%. Usually you can't read too much into that. I used to read into that when I was just beginning my investment journey. But then, there were companies like Google that came out that they would have a 37%, then 30%, then the next quarter would be 45%. And the natural inclination is to think that the law of large numbers is prevailing, as a company is getting bigger, right? The revenue has to slow down because it's harder to grow on a big number, right? But it really proves to be often misleading. This company has a lot of one-time costs. It's sort of in the stage of their life cycle where they still have still young, Y-U-N-G, young. And that's why I mentioned the balance sheet before was pretty skinny. All right, so one way to look at the company, we can't quite do it yet, but I'm tempted to. I'll show you what I'm thinking anyway. Is to take these cash flow numbers and just say they generate about $1 billion of cash flow a year. And if you do that, you get around a 45 times earnings multiple, which is actually rather cheap for a company growing at 30%. So my instinct is to, and I'm pretty long right now, so I was going to press the buy button, but I have a bunch of tech long. I'm starting to get too crowded in tech. I've always loved this company. Let's see how the stock has done over the years. They reported a couple days ago, that good quarter we were just dissecting. Wonder what happened there. Maybe that was the report. That could have been it. I don't know. Volatile. It's generally been a volatile stock, but it generally has been a very good stock. Well, it's come down with the rest of the market, I suppose. I guess over the last year, it's sort of just, it went too ham, and it's come down, but yeah, looks like a good long to me.
Order filled.
Yeah, I might have to. Thankfully, this portfolio contest has no rules, so. But if it did have rules, I would probably have to trim Liquidia, but it doesn't have any rules, so I don't have to trim it. There's no rules in this contest. I mean, after all, that guy lost half his money already, so why should I have any rules? But yeah, it's a very large position relative to the account value. looks like the server business is dropping. I don't even know what server product they have, but the other businesses are blistering growth. So I think the growth should continue to go crazy, because even if this business disappears completely, these other two businesses that are growing rapidly will dwarf these businesses that are not growing, server and marketplace. So basically, you can eliminate those businesses, and they'd still have more revenue and faster growth. Let's look at what the cloud growth was. That looks like, shoot, almost doubled. That's crazy. I mean, basically, Jira is like the new Excel for the modern world. It's what the world uses to be productive. Not everything, of course, sells. Most tasks are financial related. Most tasks don't require a spreadsheet, but all tasks kind of require Jira. So it's really a incredible product that is seeing more and more use. It started off just for programmers, really, but now is a product that's used more widely. Thought Patrol is here. Get on the ground, Thoughty. Yeah, I don't worry about the macro that much. Fed hike, Fed meetings, that's somebody else's job. That's why I try to keep portfolio balanced, longs and shorts and things like that. If I started betting on Fed outcomes, it'd be a different thing than what I am. There's some people who want to be everything to everybody. I'm comfortable just doing what I'm good at. Knowing what I'm good at and sticking to it. Which is, I'm a company analyzer and just only in a few sectors. And for a long time, I wouldn't even look outside of biopharma, because I was too scared going outside my expertise. All right. Okay, 252, 106. Let's see how revenue growth was in Q1. Revenue growth is 34%. So again, like if you look at those three numbers in sequential order, you can't divine that growth is accelerating or growth is slowing. So the first derivative is positive, right? You have revenue growth. But the question really is not about revenue growth. The question is about the second derivative, which is what is the rate of change of that revenue growth. And again, the temptation is anytime you see a down sequential, and I'm really speaking for myself here. I mean, maybe other people can avoid this emotional construct. But for me, the temptation is to look at that, any sequential deceleration of the second derivative, and say, oh boy, growth is slowing, it's all over for Atlassian or whatever. And in the early days of my career, I thought it was all over for Google or Facebook or whatever when I saw that second derivative slow. And again, next quarter you just see it pick up again. Or stay the same, and you'd be mystified because you naively thought that the growth was slowing. And again, this comes from the so-called law of large numbers. It's easy to grow 40%, for example. Take a look at this. When your revenue is only 460 million a quarter, which is big, but then how do you grow that 40% as you start to think about, okay, well now the revenue I'm trying to grow is 600 million, and maybe the quarter's down here. Your revenue year over year is, okay, with 700 million, so to grow that 40% is harder because I have to add so much more revenue. And you get to a point where you can't grow 40% forever in a compounded way. But the reality is that's not the right way to look at it. You have to sort of look at what part of the TAM have they kind of captured when you think about the target acquisition or target addressable market. If they haven't really even scrape the surface of the TAM, or they're creating, more importantly, they're sort of creating a brand new TAM that haven't even been thought of before. you know, that's the kind of thing that, you know, it sort of just changes that whole law of large numbers BS. So the law of large numbers is maybe the worst way to look at this kind of stuff, and it's kind of the worst, you know, heuristic ever sort of used in finance. Done more damage than lots of other ones. All right, so let's do one more quarter here. We'll have 2 full years of financials. So this was 6/30/21, 6/30/2020, and then I'll throw this in GitHub for anybody interested. Perpetual license and other interesting. They changed the way they report. They used to probably have perpetual licenses, and perpetual licenses model has sort of died in software. It used to be how some companies sold software, including Oracle and others. It's a very old school way of selling software. Now it's all subscription, which I think some people like. You know, I think the enterprise clients like that. Okay. Pretty clean financials. I mean, the other line is a little fucked up, but that's pretty typical, I would say. Be curious on some of the rev rec stuff. Deferred revenue is a lot sometimes to software accounting. And revenue recognition, that's kind of tricky. Well, let's look real quick at the other growth rate. So there it is again, right? 30%. You might think, oh man, the growth is done for Atlassian. Then boom, 34%, 37%. It's like, well, what made the growth accelerate? Could it have been a new product? Could it have been a change in selling strategy? It's probably just the TAM getting filled out. And you know, I think people who are very financially literally minded, they often will not see the forest for the trees. You have to go out there and actually talk to users. You have to go to the user conferences. You have to really get a sense for what the heck is happening out there in the real world and match it with the financials, and don't take either one too seriously. You have to take a look at cloud, right? Their cloud growth is the fastest with the most year-over-year kind of burden of that large number. So it looks like they haven't been reporting by divisions like cloud and so forth. They just started doing that, it looks like, which is fine. Their choice, right? But it's interesting they're now segmenting their business that way. So next quarter we'll see how they refer to cloud. So cash flow, very important. Let's see how they did on that side. All right, 184, 367. So ignoring CapEx for a second, oops. The last 8 quarters of cash flow, they averaged 202, so that's, call it 800 annualized. But the last 4 quarters of cash flow, they averaged, well, 209 as well. So it's 209 and 195. So cash flow itself maybe hasn't grown that much, which is a little concerning. You know, again, it's okay to reinvest in your business, and if you actually cut this R&D line, say, in half, let's see. Well, that's where cash flow is. Hold on. Maybe you could bump this 100 million, maybe 200 million. So yeah, call it $1 billion. Just thinking out loud here. Sort of 20 times revenue. A little less than 20 times revenue, but the margins are so good. Yeah, I think it'd be pretty good long. I'm not going to come up with an exact number right now for what the stock is worth or what the company's worth. It's going to take some more time to mentally kind of think that through, but that's a start of Atlassian.